Access to this webinar is for educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades. All securities in order to discuss, contract, and monitor virtual trading accounts, virtual account prices, and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, neither philstockworld.com, PSW, nor Skillets, or any of their respective officers, personnel, representatives, agents, or independent contractors, in such capacities, licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing contains webinar website promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics, risks, and standardized options. PSW provides education and training services and meant to seek and potential rewards for trading options. We are not a service that tells you where to trade. We are not implying guaranteeing any profit. As always, do not trade with money we cannot afford to lose. Past performance does not equal future results. Any results discussed in this webinar are not typical and only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured we take your privacy very seriously and will not distribute or sell your information to anyone. All right, that is fantabulous. Now, what is going on today? Let's see. Oh no, what? Where'd Thinkorswim go? It's always something. All right. Momentito, and I will have to restart it. I don't know what happened to it. I definitely know I restarted it and thought it went correctly. Dun, 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 dun. All right, hang on. Sorry about the delay now. Hopefully it'll restart correctly. All right, charts. All right, this looks okay. You guys see this all right? So we're kind of languishing right now. We're not down so badly. Dow's down to about 75 points. And it's, the financial network, CNBC and Bloomberg, are going with the Powell testimony. Meanwhile, Lighthizer is also testifying on the China stuff, and that's could have gone better, I guess. He's obviously not as enthusiastic about the deal as the other guys are. Tesla's popping because Elon Musk is promising a surprise. We knew he'd do something to try to push the stock up. And what was I going to say? What else is going? Michael Cohen is testifying, of course. That's fun. All right, cool. All right, so all kinds of stuff. I mean, so much stuff going on at the same time. They could have stretched it out over the day or something. It's all crazy. Markets don't seem to give a crap. It's amazing to me, but nothing seems to bother the markets. At some point, they manage to find their way up. So we'll see how that goes. Nothing notable here going on at all. Oil had a nice pop along with everything else. Look at gasoline. Look at that gap up. 150. I mean, yesterday we were at 154 yesterday, and now we're at 176. That's crazy. Now, it's a new contract. This represents a new contract gap, but the new contract gap was huge. That's a big, big blast on the new contract. But that's what we said last week. Somebody said, what do you think about gasoline? I said, because there's such a big gap between the contracts, we knew the spread was there. That means you'd see selling into the rollover of the contracts because people don't want to pay 10, 15 cents. People don't want to pay 15 cents just to buy another month. Could you imagine? I mean, gasoline's only $1.50 a gallon. If you pay 15 cents a month, you're going to pay double the cost of gasoline just to keep taking your demand. So all these people who didn't really want the gasoline have to get out at this point. They can't keep pushing money into it and pretending that they want gasoline that they're only going to eventually cancel. So anybody who didn't really want gasoline had to get out now. But the good news is, so these are probably more real buyers at this level which means it's a more sustainable price. So you hopefully won't have that kind of fallback. But gasoline's much harder to predict than oil. We really just kind of go by what the current demand levels are. And last week was a holiday week, and we had a big drawdown in oil, and you should take a look at that. And we won't worry about Powell and everybody else because it's really just kind of noise at the moment. So let's see where we are. Let's take a look at the EIA report, because at 1 o'clock we get the detailed report. Petroleum. Let's see what's going on there. So the first thing you always do is check to make sure you're reading the right report. The week ended February 22nd makes sense since this is like the 27th. So when was the holiday? It was here, right? So yeah, so it's like a holiday week. It's a week that ended on 22. So it included the holiday weekend, and we got a big drawdown in gasoline. And you want to see what else changed. So when you try to make heads or tails of the thing, you say, well, why did we have an 8 million barrel drawdown? It went from 912 to 894. That's 8 million barrels, just as advertised. But what actually did change? So you got a big drawdown in crude. Actually, it's like 54 to 45 is, well, I guess call it 46. So it's about 8.5 million barrels down on crude. Gasoline down a little bit, couple million. Distillates flat. All other oils also went down quite a bit. They all went down from 13 to 6, so that's interesting. The oil and the SPR, nobody's touching the SPR. But look what happened a couple of weeks ago. A huge amount of oil was moved from the Strategic Petroleum Reserve out of that inventory. 16 million barrels were moved out of the Strategic Petroleum Reserve. So, you know, that didn't happen here, so that may have caused the shift where all of a sudden more oil is coming out. Exports are insane. We're exporting close to 3 million barrels a day. So we're exporting 20 million barrels a week of oil. We're exporting more than almost any other country consumes. Okay, like not many countries consume 20 million barrels a week. We're exporting them. We can say we're 20 million barrels a day, but of this 20 million barrels a day means 1/7 of our total production is for export. That's a big number. So, you know, the shortage or the draw in oil is being caused by this massive amount of exports that we're doing. And also look at the imports. See, we went from 4.2 to 3.6 in imports, so we imported a lot less crude oil this month. So that also impacted us, which gave us a very small total. So we imported about 3.5 million barrels less oil. We exported not more oil, but we still exported phenomenal amounts of oil. We didn't take any oil out of the Strategic Petroleum Reserve. We had a holiday weekend, which bumped up the thing, but the demand wasn't really that much because on the whole, we produce like a little bit less gasoline per day during this week than we did the week before. But that's normal because we stock up before a holiday. People usually get gas before the holiday weekend, and then after they get around to it whenever. But most people right before they make a trip, they'll go and start and tank up their car. So that happens before the holiday weekend. Price-wise, prices went up. So there's nothing much here, nothing to make you say, oh, that's a bogus number or anything like that. It's just that we know that there's not really this kind of demand because it's being driven by the fact that we're exporting the oil to someone else. So we may have a draw in oil, but you have to then check every other country to see does somebody else have a build in oil because we're sending so much of it out of the country. It's very tricky to track down, but the bottom line is, though, it's certainly not a game changer. Not one report is never going to be a game changer. We are swimming in oil. Let's see if we can figure that out. All right, let's go to EIA. Government. Let's see if we can get the renewable portfolio standards, electric system operating, blah, 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 New England dashboard, Oil and gas code master list, underground natural gas, so much stuff. WTI futures prices. All right, how about topics? Short-term energy outlook, is that what we call this? No, okay, let's assume it's in the short-term energy outlook. Well, that's pretty useless. Market review, crude oil. Oh, that could be helpful. Front month futures prices for crude, and it says Brent and crude, so you can see that the spread between Brent and crude is pretty static. I mean, it goes up and down a bit, but it's always there. Right now it's about $10. It's unusual when it's not. It's more unusual when it's compacts than anything else. So it's, generally you're going to see a $10 spread. The question is which one goes which way. Front months to 13th month spread. That's also a weird thing. Medium light. I can't get the inventories. Market review, petroleum products. Okay, maybe it's petroleum products. RB futures, blah, blah, blah. Now I want to see the storage. Jeez. Forecast. Data, figures, tables. Are they figures? Are they tables? What do we call these things? These are charts. Now, supplements. Summer fuels outlooks. Garbage. Full report, text only. I wonder what a full report looks like. It's the same crap. I want to see natural gas futures. No, I don't want to see the futures. I want to see the actual storage. Oh, this is starting to get interesting. What are these? Oil prices, renewable energy, world liquid fuels, estimated blah-de-blahs, change in liquid fuels. Commercial inventories of crude and other liquids. Organization for Economic. Okay, so the OECD commercial inventories of crude and other liquids are very, very high. Well, I'm sorry, not now, they're not. Now they're very, very medium, but they seem to be building and building and building. So the longer range forecast, the 2-year forecast, is that we're making too much oil. We're still making too much oil, and we're going to build up commercial inventories until they're as much as they were. U.S. production is going up and up and up. Components of annual change. Commercial oil inventories in the U.S. Okay, so here we are now, right about here in March, and we're going higher and higher. So outside of this little dip, which they actually kind of forecasting that we dip down, well, this is the summer though. This is into July, which is normal, but we're still way high in the I guess this is a 5-year range. Yeah, it's a 5-year range. So inside the 5-year range, we're still way at the top of the 5-year range, and probably they're saying we're going to bust over the top of the 5-year range. So that's interesting. So bottom line is the long-term outlook is not good, but in the short run, there should be a nice little pop in oil into the summer. Gasoline distillates, we're up at the top of the chart. Distillates, we're down in the middle, but who cares about distillates? Net imports of crude. Look at us. We're importing. We used to import 8 million barrels, and now we're going to import 0, and we're going to be a net exporter in 2020. We're going to be net exporting oil in 2020, importing nothing. That's pretty amazing. Natural gas liquids, blah, blah, blah. Well, that's interesting. Production of natural gas, component, blah, blah, blah. So why do they think it's not going to go up? I think there's going to be much more production than this. I think they're wrong. Net trade of gas liquids, commercial inventories of what? Oh, propane, sorry. Natural gas production. I don't get this. Why do they forecast this downturn in natural gas production? That's not good. That's going to really skyrocket. I mean, we're already bullish on natural gas. That's going to really skyrocket it. U.S. natural gas production, consumption, and net. Okay. They think it's going to be flat. See, I don't get that. But how does this show? Am I reading it wrong? Oh, they say consumption is going down significantly. Well, that's a pretty recessionary forecast. I don't see how they're saying that. How do you go from that to that? This makes no sense. You know, you go to the government, you think they're going to have like some useful charts, but that just, you know, when you see data like that, you're like, well, how is that going to happen? Why are we suddenly going to go down that much? Summer cooling degree days. Boy, this is a good report. Let me tell you something, though. There's a lot of stuff here. What was this report called? This was the short-term energy outlook. How did I find it? I found it under supplements, and it was the summer fuels outlook. That's what this was. So if you want to get really in depth on this stuff, that's where you can find it on the EIA site. It's a short-term energy outlook and the supplements to it. So it's kind of cool. Burns says, FTR, can you provide your view on their quarter and their outlook for the year, debt and cash flow? Okay, I don't know their outlook for the year. They're the ones that tell us the outlook for the year. I don't do my own math. FTR. I just thought, you see, my analysis ends when I look at something and say, well, gee, I don't really see how they're going to make so little money that they're not worth this much. And this much turned out to be like, to FTR, I think it was like $100 million or $200 million for the whole freaking company. I mean, this is what FTR looked like. Well, they probably haven't updated Yahoo yet, so let's take a look. So, up 22% at the moment. That's nice. Where are we? Although I think 22% might be lower than it was. Is it? Yeah, a little lower. So look, I'm just looking at, okay, well, I'm looking at this company that is now $324 million. So it's about 200, but you know, when we were looking at it, it's close to $200 million. And they've got $9 billion in sales. They're making an operating income of $1.3 billion. And I don't really care. They've got write-downs and so on and so forth. But when you look at the cash flow, okay, well, I mean, let's confine it. Their cash flow, they borrowed money, they spent the money they borrowed, and they kept their cash flow pretty tight. So they aren't losing much money. They have plenty of cash on hand. They got 360 cash on hand. They cut their dividends, so they're not paying those out anymore. The potential for this company to make an incredible amount of money. Oh yeah, and where's my nice, what the hell is this? I am a subscriber, you idiots. Let's see. Log in. Wow, Dow's only down 40 points. Okay, so FTR. So look, net profit, 100 million, 100 million, 100 million, down, down, down. But you know, we know what they did here. All right, they spent $15 billion-ish to buy Texas, Florida, and California from Verizon. All the landlines, all the FiOS services, the high-speed cable stuff is FiOS. And I wish I could get FiOS. I couldn't get FiOS. But they have a high-speed FiOS service, and they've got all their landline services and everything but the cell service they've got for these customers. All the corporate internet, everything else is all in there. So they bought this tremendous amount of legacy stuff, the stuff that people are, yes, obviously cord cutting away from, but not so fast that it's not going to be able to wreak out a very nice profit over the years. So Frontier's like, well, we could double the size of our company, and they did. They doubled the size of their company in very short order, but they have to pay down the debt, and then once they do, though, the revenues are going to come back. So if they don't have to borrow or dilute to pay down the debt, this is all I care about. If they don't have to borrow or dilute to pay down the debt, then once they pay down the debt, which maybe will be 10 years from now, they'll be throwing out a couple of $100 million, $300 million a year in profits. And if I bought that company for $200 million, I got a phenomenal deal, and it could become a 10-bagger for me. And that's all I care about. I don't really care what their forecasts are, and their forecasts are very conservative here. They're not forecasting any great things. They're not forecasting any huge profits. They're actually now forecasting better than this. But what I care about is that this company is priced like it's going to be bankrupt. And it's not. And as long as it doesn't go bankrupt, it's worth a hell of a lot more than $200 million. They just paid $15 billion for the stuff, and they're not morons. You could say they overpaid, just like Buffett overpaid for Kraft, for Kraft Heinz for the merger. They might have overpaid, but maybe they overpaid, so it's only worth $10 billion. But as long as they pay off their debt and they still have a $10 billion asset, then it's worth $10 billion. I bought the company for $200 million. So it's not about what they forecast and what they're going to do this quarter. Did they meet their numbers and blah, blah, blah. It's not important. What's important is they're not going to go bankrupt. And that's all I ask of them. So what did they do? And anyway, they're up 20%. They're up 20% because that's all people, nobody expected anything of them. Not so soon. It's still really early in the cycle for them to be putting their things together. But let's look at the slides because it's fun. And I've been banging the table on Frontier forever because I keep saying this is a ridiculously undervalued thing. You're buying a phone company. Phone companies make money. It's not complicated in this business to make money. So here's their business update. $2 billion for the quarter, 219 loss. But if you adjust it, blah, 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 it's 895 million profit because they had goodwill impairment, so on and so forth. EBITDA benefit anticipated by 2020. Well, that's their forward projection. Maturities and amortization paid $500 million. The consumer churn is down significantly. 2% consumer churn is about as good as any phone company is going to be. That means only 2% of their customers get lost in a quarter. So with all the advertising, everybody's telling you to switch and blah, 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 that's it. They had a high churn when they first did the merger because when you first do the merger, everybody's going to be upset and have complaints and look for other companies and your competitors blast at your customers because they're trying to shake them all out. But the guys you have left are pretty loyal. The cost of getting acquiring customer, $88. I don't know what that means, but somewhere in the $80 to get a customer. Commercial revenues, $942 million, which is huge. Commercial customers, 411,000. Broadband unit trends, as you can see, blah, blah, blah. They've been losing, but that's falling down a bit. They're focused on retention. Consumer net additions. Where do they see net additions? I don't see net additions. I don't know what they're talking about. Market position is solid, copper trend stable. And by the way, this is the other thing. The phone companies labor under a nasty rule that says they have to maintain the service to their copper customers. So let's say that only 10% of their customers are copper. They have to maintain a copper network that services every home in their coverage area just for the 10% of the people who still use copper. Copper cables rot, copper cables, the casings go bad, they get leaks, they get in the ground, they have to dig them up, they have to put them back, blah, blah, blah. It's a real pain in the ass. And it's a huge cost. Frontier's main goal here in the next 24 months is to try to get every single customer off of copper. That's what they try to do. Once they do that, they can once they reach a certain threshold, they can shut the copper network down and all those costs go away in a puff of smoke. And that's something else people don't understand about phone companies, that they've got this law that they have to maintain these copper networks and it kills them. And here it is right there, consumer copper broadband, this number here. They want this number to go down as much as possible. Their goal is to get rid of this, get rid of all these people. They don't want them. So they're looking to get rid of the copper guys. And that's another thing, that they get treated like they're losing customers when they're dumping their copper customers. Now the question is whether they're getting them to sign up for the new services, but they don't really care as long as they stop being copper customers. Churn, as I said, is going down. It was big. They had a big churn when they first acquired all these customers. You didn't like the new company and blah, blah, blah. You know how that happens when your company gets bought, when your phone company or cable company gets bought by somebody else, you end up shopping around. Plus their competitors will delude you with things saying, switch, use us instead, blah, 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 because they figure you're being impacted anyway. So it's a good time to come at you and offer you a better service and say, oh, don't stay with them, come over here. That's stabilizing to what, well, it says legacy churn. So legacy churn is down here. They're still a little higher than that up here, but it's nothing to cry about at the moment. Okay, it was here. This was a bad, but now it's coming under control. EBITDA, blah, blah, blah. It's the same crap. Current status, 2 solutions, capture phase, blah, it's nothing important. 20% target, reduced dispatches, call center churn, okay, whatever. Agenda, financial review, okay. Key highlights. So revenues, 2 billion customer revenues, regulatory revenues is money they get for providing rural customers with service. Cash from operations, look at that, look at this number. All right, that's a good number, $600 million cash from operating activities. Operating expenses staying flat, adjusted EBITDA and their CapEx, and that gives them cash flow, $620 million. That's a quarter. So that's $620 million cash flow in a quarter for a company you pay at the current price $300 million for. Total revenue, blah, 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 looking good. They don't have any projections here. It's just showing you where they're at. But these are good, solid numbers. There's nothing wrong with this. This is their acquisition cost. It's costing them more and more to acquire customers. Wait, ARPC, this might not be acquisition. ARPC. I don't know. Does anyone know what ARPC is? I don't think it's acquisition cost. So capital spending, they spent $1.9 billion. So this is also an investment. So your $200 million company spent $1.2 billion in infrastructure that in theory is going to make them money over time, well, they wouldn't be doing it, right? 75% of their spending is growth initiatives. The gigabyte broadband, the fifth builds, upgrading to 10 gigabits, building fiber. This is fiber to home and fixed wireless broadband. So they're building all this stuff that they make money on down the road. Manageable debt maturities. This is a big bugaboo with them. They're servicing their debt now. They've got the money. They're putting it away, and they're planning to push this down. They've got So these are their big debt chunks here. Then they get a little bit of a break, and then they go back into it. And then here's where the big money is. But by 2025, they should be cranking out the money. They don't think this is going to be a problem. So the guidance for next year, here it is, 3.5 billion earnings. That's earnings, not revenue, earnings. Capital expenditures, 1.5 no taxes because they lost money. Cash interest expense, 1.4 billion. They're still going to have $600 million of free cash flow by the end of the year. That's servicing their debt, servicing their pensions, paying their taxes, and spending $1 billion for future improvements. And they're still going to have $600 million left. Your $300 million company is going to have that much money left at the end of the year. So effectively, for every share you buy, they've got double that much money that they could pay you if they wanted to. But they can't. They can't really, because they got to save it up for those big debt payments. But when they have, eventually, if you're going to be a long-term holder, once they pay those debt payments, then that money is free cash flow that goes in your pocket, and they'll go back to paying a huge dividend like they used to. We're building up a position for the long term, not for the today. And I said that, and I went over that in today's chat. We've been talking about it. It's a big holding for us. We have a lot of them. See, this is too big, right? Control minus. Let's make it a little more normal of a size. So I was just pointing. All right. So here's what happens. So here's January, right? And FTR, as you guys know, we talk about it all the time. So Wilson's asked about CTL, and I said, look, CTL is still expensive and Frontier is cheap. I said, same numbers and whatever. I said, based on this, I'd rather buy Frontier, which is already beaten to crap, than CTL, which could be beaten to crap for the same reason. That CTL is now beaten to crap. It could go down further though. I'm more comfortable with Frontier, which I think is at a ridiculously low price. Here I was in January. Unfortunately, it's a long-term turnaround, and the progress will be measured in quarters. So it's like, I didn't want to change anything or move anything now. I said if their debt gets more expensive, then it's not good. But we expect expect the debt to be manageable, and they're going to be able to eventually pay it off. And then recently in 214, we doubled down basically on the stock that we had. So we bought more stock here. We bought in the OOP, in the options opportunity portfolio, we bought 3,000 more shares, and in the long-term portfolio, we bought 10,000 more shares at 265, which is nice because now they're at, I don't know what they're at now. They're at 310, I think, right? Let's see. Yep, 310. Okay, see, I'm very good at that. So that's what else do you want? That's what we did. It went lower, we bought more, and now, but it's a years-long play. It's not I don't really care what their outlook is even for next year. This is a long-term telephone company play that we expect to just yield returns for years to come. Average revenue per customer, okay, per month has to be per month at $84 though, right? That's why I couldn't get it. All right, thanks, guys. Average revenue per customer so it has to be monthly. I don't know where those slides went. Frontier, no, that wasn't. Is that it? Consumer average revenue per customer per quarter seems low. $4 million times 80, 400 million. So if it's per quarter, then it would be about 400 million. That's too low. But if it's per month, then it would be 1.2 billion plus the corporate is 2.2. It's got to be a monthly number. That's the only way that makes sense. So that is why they wanted to go up. It's not the cost of acquisition. It's the cost of it's the revenues generated. And this is good. What this means, though, if that's the case, that means that basically they're shifting the mix of their customers. So they might lose some customers, but the customers they have are buying more expensive products. All right, and again, it's what I said. They're pushing the copper customer out. The copper customers are the ones with a freaking landline dial phone that still have a princess phone in the bedroom. They're getting rid of those people. They're not doing them any good. They're losing money on those customers. They want to get rid of them and change them into higher producing customers. So that is that story. So a monthly, thanks, Bern. All right, so anyway, so that's what I do like about it. Okay, it's a telco. The funny thing is, see, in my mind, when I think of a telco or a cable company or whatever, it's like, like Time Warner back in the day, AT&T, obviously, Verizon, when they came along, Sprint, when they came along. I've seen this play out over decades, and I don't think in terms of like, I'm not anxious about what's happening now. I just see another telephone company doing another big investment so they can get a big footprint so that 20 years from now, they'll be a huge dividend payer in a blue chip stock. These guys are late to the game the way that Sprint was late to the game and the way MCI was late to the game. Now MCI blew up, though. Don't forget that just can't happen. T-Mobile, very late to the game. They're one of the last ones that came in. Yet, here we are years and years later, and T-Mobile and Sprint are merging, and they're going to make a ton of money, and the people who bought them back in the day are doing very well. But we're talking back in the day being a decade ago, not last quarter, not last year. I've seen this play out many, many times, but I didn't sit there and when I bought AT&T, when I bought Verizon, when I bought Sprint, I never sat there and watched every quarter to see if they had a good quarter and what do they do and what do they borrow and what do they spend. That's nonsense. You got to recognize some things are long-term investments. It means leave them the frick alone. And Buffett says this all the time. It amazes me how few people listen to Warren Buffett. Really does. Here's a guy trading for 50 years, investing and trading for 50 years, almost never loses money, averages 16.5% a year, turned a few $1 million into $80 billion of his personal wealth, built Berkshire Hathaway up from a bankrupt shirt company, which is what they were when he bought them. When he bought Berkshire Hathaway, they were a bankrupt shirt company. And it's now one of the biggest S&P 500 companies. We're worth hundreds of billions of dollars. He's generated incredible amounts of wealth for tons of people. And he says all the time, don't worry about the quarter. Worry about whether you're executing your strategy. Have a strategy, execute the strategy, stick with the strategy. And as long as you do that and ignore all the bullshit and don't panic when everyone else is panicking, this is all what Warren Buffett says. It's very, very simple. But nobody wants to hear it. And it's very hard. It's hard for me to teach. You can say the words, but when it comes down to it, I mean, honestly, to buy a company like Frontier and expect immediate results is ridiculous. And to analyze the immediate results and to look for every little thing of what they're doing and this and that number and whatever, also ridiculous. Are they trending the way they're supposed to trend? Yes. Are they doing what they're supposed to do? Yes. Then let them do it. That's all. This will be a $10 stock. Easily be a $10 stock. It's a $3 stock now. But it'll be years from now. Maybe it's 4 years, 5 years. I don't care how many years it takes for my stock to triple. I really don't. I'm very happy with it. And then plus, once it does triple, we're going to cover it. We'll sell options. We'll collect dividends. That's all. I wish they would have gone lower. I could have sold some puts. We don't have enough puts out on them. In the long-term portfolio, I think we still have puts, but in the short-term portfolio, I didn't want to take any chances not in the short term. In the options opportunity portfolio, see, in the OLPC, we bought back the puts because I didn't want to take a chance on getting really burned, because we sold them for 270, and then they were 310, so we were down 40 cents on the puts. So I said, let's buy those back. We'll take the loss of $1,200 because like 30 of them, and we just bought more shares. But I didn't want to buy more shares and still have the puts and take a double hit just in case. As it stands now, I wish we would have kept the puts, but we didn't. So what? We might sell some more puts. I have to see what the prices are. I mean, if you look now at FTR puts, but that's because it was the options opportunity portfolio, and it would have been badly damaged because it was becoming a large position. So I didn't want to take a chance. Now the $3 puts are like 150, 155, 150, whatever. We had the $5 puts for 270. So I'm pretty comfortable selling the $3 puts for 150, so we can get back in and sell some of those. In the long-term portfolio, though, we didn't buy back the puts because we could easily afford it. It's even with 20,000 longs at $60,000, it's not a big deal position for us. So we spent $26,500 more and bought back, and we even bought back the short calls. So we just have the short puts and the short calls in the LTP. But again, it's a long-term position. And in the long-term portfolio, that's what we'll do. Now, in the short-term portfolio, we will probably play more for an income, not the short-term, sorry, the options opportunity portfolio. You play more for an income. So at $3, I'm looking ahead and I say, oh my God, look, I can sell the $3 calls. Think about this. I don't have to we own this stock now for $3. I can now sell the $3 calls for $1.60. In fact, they sold for $2 today, apparently. I can sell the $3 calls for $1.60. I can sell the $3 puts for $1.50. That's $3.10. So we can sell the puts and calls on FTR at $3, 2021, and collect $3.10 for selling the puts and calls. What does that mean? That means if it gets assigned to us at $3, we double down for 10-cent credit. That's our worst case scenario, is we'd be forced to buy another round of FTR at a net 10-cent credit. We collected $3.10. We'd have to pay $3. We get the stock, obviously, that we pay $3 for. And it didn't cost us a thing. So our worst case scenario is it would reduce our basis by 50%. Our best case scenario, we would get called away at $3, and we'd have $3 in our pocket already from selling the puts and calls, and we get another $3 for the stock, which means we can then have a double in 2 years. We can make 100% back on our position. Right now, we can do that right now. And in the options opportunity portfolio, I'm probably going to do that because that's the correct conservative way to play. In the long-term portfolio, I might do it with half of it. That is the correct conservative way to play because we can collect, if we just bought 10,000 shares for $26,000 in the long-term portfolio a couple of weeks ago. We can now sell 100 puts and calls for $31,000. So we make a $5,000 profit over what we added in last week. We're taking $31,000 off the table. We still have 20,000 shares. And the worst case scenario is that we'll be forced to buy another 10,000 shares, so 50% more shares for $0, which would knock the net of the trade down by 33%, would knock our net cost down overall by 33%. Because again, it cost us no money. The $10,000 we spent last couple of weeks ago, the $26,000 we spent a couple of weeks ago to buy 10,000 shares is back in our pocket. So we spent nothing, but we doubled down. So last week's, or 2 weeks ago, whatever it was, last week's double down for $26,000. We're taking all that money back plus a $5,000 profit. Just 2 weeks later, we still have our original 10,000 shares, and now we have the puts that say, worst case scenario, we would have to put back, we have our 10,000 shares plus the 10,000 we bought last week. We didn't change that. We're getting the money back, or we're giving the shares back. And so now we have 20,000 shares covered with 100 puts and calls. So in the worst case scenario, what would happen is we'd have to redeploy the $30,000. So we go back to where we are. We'd have $50,000 into the trade, but then we'd have 30,000 shares. So 50,000 divided by 30,000 is not even 20. So for less than we'd be in for less than $2 a share on the overall thing. That's what you do with these kind of trades, and you know, with these huge options prices, this is crazy. And it just shows you how all over the place people are with FTR. These guys will bet you $1.60 it's going to be over 3. These guys will bet you $1.50 it'll be under 3. But you sell it to both of them. Why wouldn't you? And again, as a brand new trade, if you buy $30,000 worth of FTR now, and you sell 100 $3 puts and calls for $31,000. You have a net $1,000 credit. You have 10,000 shares of Frontier, and if it stays above 3, you get called away with $31,000, and you've got no out-of-pocket money at all. And if it's under 3, the worst thing that can happen to you is you will be assigned 10,000 more shares for $30,000. So now you'd be into $30,000, but you'd have 20,000 shares. You paid $1.50. So again, it goes back to the same thing. If you don't think they're going to go bankrupt, why wouldn't you do this? All right, so that's that for that. I'm done with those guys. Todd says, time to get back into GE. Gifts, like, because of the up and downy thing. I don't know, do they have the new stock yet? Do they have the new options? I don't really understand them yet, so I would say, yeah, I'll say yes, but remind me over the weekend to like look them up. See, the problem is we don't know what GE is without what they spun off. So they spun off this thing. I don't know what the value of the new company is. I don't know if it really is 1072. You know, this WAD was something. It's a unit that made money. It had revenues. It had profits. It's hard to say. Of course, it also had debts. So there's pluses and minuses to the whole thing. You got to look at it as a brand new company now and try to figure out where they are. And there's no way there's enough information to do that right now. I want to get back into GE, but I'm not ready to. And look at this. I would have to sell a $10 GE put to make as much money as I make selling an FTR put. And I do understand FTR. I don't understand GE right now. I do understand FTR. I feel much more comfortable selling the FTR puts than the GE puts. So at the moment, no, I'd rather do more FTR if I was going to do anything. Okay, good. So we're done with that. All right. What else is going on? There's GE. Look at that 12. That was perfect. I mean, I sent out all those alerts right around here when it's flying up. I was like, let's get the hell out of this stupid thing. Because people don't understand that when you split up a company, you're rolling off a division. That division is not going to generate revenues for GE anymore. Now, of course, as a GE, if you were a GE holder on that day, you got the spun off company. So now you have your GE shares plus you have the 1/2 share of the spin-off company. But again, it's just until we figure out like what the revenues are and how they distribute it and who they settle with debt. Caesars is brilliant at that. Caesars is always doing spin-offs and dumping all the debt on the spin-offs so CZR can be clean again. Like they rack up a whole bunch of debts, then they do a spin-off and they load all the debts into the spin-off and they go, hey, look at Caesar, we got all these assets and no debt, which is what Trump used to do too. I mean, it's a real estate move. I mean, people do that. It's borderline criminal, but it's what they do. So what else is going on? So these guys, they're there. Nothing exciting. Okay, nothing going on here. Oil, Brent, gasoline, natural gas. How's my coffee doing? KCN 19. Oh, nice. Okay, so coffee is flying back up. All right. So nothing to report here. Nothing really exciting to trade in the futures, unfortunately. There's not any particularly good things going on. Let's see what's going on in the news and see if anything exciting is happening at the moment. And then I want to see how they're summarizing what's going on. We got all this stuff happening, Powell talk, Cone talk, and the markets are really not particularly reacting. You know, I mean, I guess this is good. You're back to, let's go back to the Dow. YM. And the Dow's only down a bit. The S&P is actually up a tiny bit. These guys are flat. So, you know, on the whole, I mean, we're surviving all this stuff. We'll see what happens. And as I said this morning, technically we're bullish. You know, this is very technically bullish. Harris, global economy shows signs of perking up, Goldman says. Oh, wow. If Goldman says so, it must be true. Some green shoots are emerging. So yes, potential growth. Their current activity indicator is up a bit, but they downwardly revised December. Risks of firm's GDP forecast of 5% is probably still on the downside. How could they even have that forecast anymore? I mean, you still got the whole Brexit thing. Aside from our bullshit, they still got the Brexit to deal with. Elon Musk says Tesla news is coming tomorrow. Company will have news out tomorrow at 5 o'clock Eastern. The announcement will arrive ahead of the repayment date. So 1 day ahead of the repayment date, tomorrow at 5 p.m. That's weird. Of the convertible notes, Tesla doesn't have any events scheduled for tomorrow on its investor site. Elon Musk has changed his Twitter handle to Elon Tusk. Oh my God. Okay. And yet the stock goes up 5% on that news. I'd be like, I really don't understand people. I don't. I'm like, that's not where I would be putting my money. TSLA. It sounds like he's really unhinged. So I don't know. Tomorrow at 5 p.m., March 1st is their conversion date. And if the stock is not below, if the stock is above 360, everybody automatically, all the $1 billion, $920 million worth of bond holders, their debt will convert to stock automatically if the stock is over 360, as of, I believe it's March 1st. But March 1st is, what's today? Oh, it's Wednesday. Oh yeah, March 1st is Friday. Does he think he can get the stock $40 higher by Friday? He seems to think so. He's acting like he can. It's kind of crazy. I don't know what the hell he's going to announce. And he's risking an SEC violation by doing it. They're already pissed at him for tweeting out stuff. That's going to be interesting to watch. Anyway, so the thing is, on March 1st, so on Friday, if Tesla stock is above 360, the $920 million of debt that's due on Friday automatically converts to Tesla stock. Now, it doesn't say, which I think next time investors are going to wise up to, it doesn't say if it averages it for a week or anything like that. It only has to be above 360 on that day, and they get the stock shoved down their throat. So for Tesla, it would be a very big deal if they could have the stock up for above 360 on Friday. I would be amazed if he pulls that off. They would have to announce something really spectacular, and tweeting about it and teasing it and then announcing it is blatant stock manipulation. So, you know, the stock might go to 360, but then the CEO is going to be in big trouble and possibly getting fined or sentenced for this kind of thing. It doesn't make me really want to jump on the Tesla bandwagon, but it will be interesting to watch. Certainly, if they do that and they force all these guys to convert, don't forget it's also diluting the company by $1 billion worth of stock. I think I would definitely be shorting around here. I'd love an opportunity to short them again. But that's kind of crazy. What else? Stocks erase most of the morning declines. Lighthizer says the U.S. is pushing for structural changes in China's model. We know that. He's less optimistic than the president. We know that. Powell's done. He said all the good things that they wanted him to say. Wedbush warns of Zillow near-term risk. Yeah, Zillow is really stretching also. There's another company that's trying to act like they got it all together, but it's kind of scary. Frontier made a midday mover list. That's amazing. It's been so long. Best Buy also kicking ass. Best Buy really doing well. Do we still have Best Buy? No, we have Best Buy. We used to have Best Buy. It's a shame. Oh well. Where are we? Fed has a framework for ending balance sheet runoff. Powell says Fed's worked out a framework to light the way to the end of the balance sheet shrinking and asset runoff. He says the balance sheet's never going to go back to like where it was, which is interesting. So let's see how that looks. Amazon. Have I heard anything else about the Amazon plane crash? Did that hurt their stock? I don't even think it hurt their stock much. Yeah, they've been sort of flatlining. Dividend, oil plus 3%, stockpiles plunge. Let's see what they say about data. Unexpected drop. Futures were already higher after the Saudi minister said they were taking it easy in response to Trump. U.S. stockpiles fell by 8.6 million shares, more than twice the drop expected. Okay, so nothing. Best Buy, holiday quarter. Best Buy up 16.5% after impressing with holiday quarter, topping comparables. Best Buy cited strong demand for wearables. Now, see, here's what you want to know. Why are they up? Wearables, appliances, durable goods, that's good. Smart home devices during the quarter, and noted over 1 million members signed up for their technical support program. That's interesting. We continue to drive efficiencies and blah, 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 blah. Okay. Best Buy is very good. That Geek Squad thing really works for them. Mattel and MGM are partnering on a Viewmaster film. Oh, please. Planet Fitness is doing good. Boy, Weight Watchers got killed. That's one I want to look at actually for a bargain perspective. Like, I want to see if it's really as bad as we think. U.S. seeks enforceable China pact. We know that. You know, considering all the crap going on today, there's not much, right? IMAX had kick-ass numbers. They look good. Nope, not much else going on. All right, and then there's obviously the Michael Cohen thing, but nothing, you know, honestly, nothing really killer for Trump. You know, it's nothing you didn't know that he was doing, so it's not like there's nothing shocking here that's going to unravel him. Cohen paints a dark picture of Trump, Trump versus Trump. Cohen's testimony could create new legal issues for Trump. I mean, it's not, all right, let's see what they say the new legal issues are. I doubt there's anything with real teeth. And yes, you know, my attitude about the New York Times is it's a fantastic paper. They are usually factually accurate, but yes, I would say the average New York Times reporter certainly has a more liberal attitude than most papers, so you do have to be careful about how they present a headline or what they say. But it doesn't mean it's wrong, though. It's very unlikely that they may lean a certain way and push a certain way, but I very rarely find them factually inaccurate, which is why I really read the New York Times all the time. You know, they don't just make shit up. But that doesn't mean it's, but when you read something interpretive like this, it doesn't mean it is. All right, so legal experts said several, and you don't know how we have a legal expert lean. Conspiracy, the campaign laws, obviously he did. There's no question about that. Nothing dramatically altered what is known about any legal case against the president. Oh, well, that's what I said, see? The relevant laws are complex, and the president's lawyers have repeatedly argued did not violate them. The president may not be indicted while in office anyway. So hush money payments to a porn star, who cares? We know all about that. The president knew about WikiLeaks. We not only knew about WikiLeaks, he asked Russia to leak the information in a campaign speech. So WikiLeaks campaign fine. All right, federal law campaign taking any so you can't take anything of value from a foreign entity, and that's where he's in trouble. That's bad because he did do that. Trump Tower, Moscow, and his reports, Mr. Cohn, and then Trump knew about it. He lied about Trump Tower. We knew that too. The Trump Tower meeting, so there was some spies in the Trump Tower and having a meeting with his kids. We knew that. And well, here's a good one. In his remarks, Cohn said Trump directed the Trump Foundation funds to acquire a portrait of Mr. Trump. This portrait was purchased by a fake bidder. Trump directed the foundation to repay the fake bidder and kept the art. All right, that's bad. So that's fraud. But again, it's a little fraud and a little fraud. Proportionally, it's a little fraud. It's not like the kind of thing you impeach the president of the United States over. So it's a fraud. He should be fined, slapped, whatever. But it's not the kind of thing you take a guy out of office for. So like they said above, there's not really teeth here. And that's why I read the Times, because they much as they hate Trump, they're going to be more fair and balanced than the Post is about something like that. So you read the article, you have to take it with a grain of salt if they're going to come down negative on it. But when something like that seems pretty fair, right? Now this Pakistani thing, that's interesting. Now Pakistan says it shot down 2 Indian planes, and India didn't shoot down any. So Pakistan says they won this exchange. And that looks like 2 planes to me, or at least 1 plane broken in 2 pieces. But the Indian fighter jets crossed into Kashmir, and they shut them down. So I mean, that's why they have these zones. You're not supposed to cross over. Still, it's kind of ugly, and it could get bad. But the one thing is that the guy who runs Pakistan, and God knows what his name is, said that he said to Modi through the press, he said, hey dude, we need to talk about this before it gets out of control. So that's coming from the Pakistani leader, that's kind of encouraging, right? He's like, dude, like we shut down your planes, okay, like I don't want this to escalate, so how about we get together and talk instead of shooting at each other? Which is easy for the guy who just shot down 2 planes to say. We'll see how that goes. It's always good to hit somebody, it's always good to give someone a bloody nose and then call a truce. That's it. Nothing is going on. This is very boring. Considering all the crap going on today, you got Cohn testifying, you got Lighthizer testifying on China, and you got Powell testifying all morning long. This is a boring ass day with hardly anything happening news-wise. So very interesting. So ask some freaking questions, because otherwise you've got nothing to do. Any toll after earnings, Brian says. All right, so should we look at Toll Brothers? And what was the other one I just said? Come on, brain. What was I thinking of? Weight Watchers. Are they WTW? Before I forget, I want to do Weight Watchers. All right, so Weight Watchers, $2 billion at $20. Revenues, $1.5 billion, making $199 million, and may put some PE about 10. That's not terrible. But the question is, how badly did they actually screw up this quarter? I mean, they got slammed. So let's take a look at them. Hopefully they have a slideshow for us too. They have an earnings call transcript. I don't know if they have a slideshow. Don't seem to. No, I don't want to be sexist and say the thing about female CEOs, but I got to tell you, the female CEOs tend not to do slideshows compared to male CEOs. Guys love slideshows. I'm not going to read through all this. That's bullshit. All right, let's see if we can find the numbers at least. Weight Watchers, guys. Okay. Oh, that's awful. Well, look at that. They're guiding massively. Look, from $3, they're guiding down to topping at 150. Revenues at 1.4. So revenues is a big thing. Soft start of the winter season. We expect member recruitment to be below 218 levels, lower revenues. What happened? Wow, I feel I'm gonna have to. I want to read this conference call. I want to know what the hell went wrong with these guys. I mean, yeah, they had a big bump from Oprah, but, and again, I wish I had some slides. They had a big bump from Oprah about a year or so ago, but how would that make such a horrible thing? Entering international markets, leader health and wellness, hit by seasonality or heading for another profit warning. Well, that was a good call by this guy. Wow, look at you, the Belgian dentist. I like that. Weight Watchers third quarter results were a profit warning in disguise. Wow, dude, you nailed it. Got some respect for this guy. I'm gonna follow you. The hell? Let me see that. WTW. Nice call, buddy. So this is him in December. So on just at the end of December, Mr. Belgian dentist is telling us. So here we are, December 27th. So really around here, $40. At $40, this is the Belgian dentist take on this thing. Weight Watchers were a profit warning. Now we got out of it, fortunately. We picked them up when Oprah first came in, and we picked them, and we got out when they got too expensive. I was thinking about getting back in, but this is awful. A month ago, Weight Watchers announced their results, and they had a GAAP EPS of 315. Blah, 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 blah. Stock drop. What's going on? Here you go. We posted a bullish article on Weight Watchers, operational leverage. The tax rate, of course, was a big thing. The thing, the tax rates provide these one-time boosts for these companies, but then after that, how are they going to make the money again? One of Dennis Garman's 19 rules of trading is remember there's never just one cockroach. As a city person, I believe that's a very good rule. As Weight Watchers hit by seasonality or heading for another profit warning. End period subscribers. Wow, nice. Okay, I like this guy. He's really getting into it. He's predicting this downturn. Look at him. Valuation and price target, free cash flow. We were expecting this. It's actually going to be much worse than this, though. Price momentum, the price chart conclusion. The sentiment around Weight Chart was very negative and clearly reflected in the current valuation. Trades at 4P of only 12.3. It might be wise to wait for the next quarterly results. Damn well. See, Weight Watchers reaches its targets. Revenues, if not, Weight Watchers 2020 end of 5 million revenue may be in jeopardy. It's very much in jeopardy, apparently. The article provides opinions and information. Okay, wow, good job. That's. I tell you, there's not many guys on Seeking Alpha really nail it like that. I got to see what else he writes. This is stunning, and it bears more looking into. But I mean, this is really I don't see how they can do that. Revenues, I mean, the revenues aren't that awful, but I guess that's all their profits out the window. Super disappointing. I mean, unbelievable. So we shall see. So Weight Watchers is out, and we were going to look at Toll. We sold $35 puts on Monday for 5 and wanted to see the earnings. All right. Okay. Thanks, Brian. And see, that's how it works. If I have a feeling, like somebody had asked me about Toll and whether or not I thought it was a good play, and I was like, well, fiscal Q1 blows away consensus. Apparently, they've given some of it back today, but not much. So let's see where we were. Whoops. No, stop. There. That's not that good. So they had a pop yesterday, but it didn't last and sort of fading out around here. But still, I mean, the numbers were certainly supportive of where they are. Well, they made 76 cents. Revenue's 1.3 billion. Press release. Let's see how that looks. Ooh, that's good. That's some good numbers. All right, let's see. Net income 112.76. Last year 132.83. Oh, let's see. Deferred tax liability. See, look at this though. First quarter, they had a ridiculously low tax rate, and that's over. Pre-tax income, home sales revenues were up. That's what I care about. Are they selling homes or are they not selling homes? Net contract value is down. So they're selling more homes that are cheaper. Backlog value 5.7. Backlog total is there. Home sales gross margin was 21%. Excludes was 24%. So margins are shrinking. Land sales don't matter. SG&A as a percentage of home sales revenue. So they're spending a lot of money pushing advertising, hiring salespeople, so on and so forth. Income from operations was 9.1%. Doesn't say what it was. Other income, don't care. Company repurchased stock, which is obviously making a trick as far as how much earnings per share they have. Deliveries. Wow. Look at this average price. That's crazy. I just don't understand how people can afford to live these days. It's crazy. Anyway, so Toll, very good. And overall, TOL. Nope. TOL. These guys. All right. So overall, they're pretty much in line with what they usually do. We're talking about a $7 billion in sales, $700 million in profit, 10% profit drops to the bottom line. You can buy the whole thing for $5.4 billion. So why wouldn't you? So yes, the initial thing was based on what we know about Toll was unless they really screwed up, I didn't mind selling the puts, and I don't know what puts they were. The 35 puts on Monday for $5. So we sold the $35 puts on Monday for $5 just to keep our eye on. So now the 35 puts is still $5. So that hasn't changed. Nothing's really changed. So do we want to add a bull call spread? Well, they didn't go down, but they didn't go up. So really we're in the same position we were. So really it comes down to, is it attractive to buy a bull call spread? I I'm not positive that builders are going to have a great time in a rising rate environment. It's still going to be, rates are not going down. They're going to probably stay flat or go up. I think consumers are under a bit of pressure. I think that average 860,000 per home, you know, in their price point, they're catering to the top 1%. So I don't think they're really worried about how the rest of the economy is doing. But that if their competitors are struggling and such, you see, you know, if Lennar is averaging 400, 500,000 per home and Toll's averaging 850 per home, it's very unlikely somebody's going from the Toll development over to Lennar and is going to say, oh, you know what, this one's much cheaper. That's not how it works. You know, a person buying $1 million home is looking for $1 million home. They don't even want to look at a $600,000 home. You could easily argue that the $600,000 home is just as nice and probably way better for the money and all that thing. Doesn't matter. People who are looking for $1 million homes don't think that way. They want a home that's in their price range. That's why brokers will usually ask you first, how much you looking to spend on a house? And you tell them what you want to spend, and then they show you houses. They don't, you know, when you go to a real estate broker, the real estate broker doesn't say, well, how many bedrooms do you need? I need 3 bedrooms. Oh, wow, I got 3 bedrooms for $1,000 a month. You want that? They never do that. That never happens. They ask you how much you want to spend, and they try to spend as much of it as they can. That's why most people live in houses that are just way bigger than they actually need. I'm not any different than anybody else, but I'm just saying it's ridiculous. And you really realize when you move and you try to like sell some of your stuff that's in your house that you thought you need all the space for, that your stuff, as much as you might love it, is basically considered junk by other people. And if nobody wants to buy it from you, in fact, you can't even give it away. I got plenty of things I was trying to give to people. I'm like, you don't want this couch? People are like, no, I don't. I'm like, this freaking $7,000 leather couch. Nobody wants it. I actually literally could not give away a $7,000 couch. I could not give it to. I didn't want to take it to Florida. It wasn't worth shipping. You know, it's like, because it wasn't going to fit in the apartment. It wasn't the right size, and so on and so forth. So I'm like, I was like, so like, ugh. So frustrating. I mean, you know, 10 years old, it wasn't brand new. It was 10-year-old, $7,000 leather couch. Nobody wanted it. It's like such a waste. So what do I have in Florida? Another $7,000 couch. So see, and 10 years from now, nobody's going to want that. Anywho, where are we? Oh yeah. So is there a compelling reason to buy a bull call spread? So if we say they're good for 40, that's $5. Obviously, we can buy the 30s for $10. That makes a $5 spread on the 30-40. It's not. If you want to, that would be the way I'd go. I'd pick up the 30-40 spread for $5. But is that a compelling way for us to use another $5,000 in the portfolio? No, not really. You know, we sold the short puts, and if we sold the 30 puts for $5, if we get assigned, not the 30s, the 35 puts for $5, sorry. If we get assigned, we'll net in for $30. And then I'd make a bull call spread, and then I would feel pretty good about the whole thing. Because we'd have the 25-35 bull call spread for $5, and I feel very, very confident we get back to 35. I don't feel unconfident they'll get to 40, but on the other hand, it's not such a compelling thing that, you know, what would I rather bet on? Would I rather bet on these guys to go up to 40, or would I rather bet on Apple to do the same? So bang for the buck wise, AAPL, same thing. So we look at the let's say the 190s proportionally are $18. And if I do a $10 spread, that gets me something for $28, like the 170s. And the 170s are, in fact, not even. They're $27. So 27 for the 170s and 18 for the 180s is $9. So on Apple, the 170, 190 spread, well, all right, let's say we do the 180s. Let's be even closer. let's say the 180s are 22, the 160s are 32, so that's $10. So here's Apple. I mean, the same 100%. Betting Apple goes from 160 to 180. Betting the 160, 180 Apple spread, I'm in the money 3/4 of the spread. In the other one, I'm only half in the money on the Toll Brother. And I'm tying up the exact same amount of money. Well, obviously more because Apple's a bigger stock. But I'm tying up the same $5,000, the same $10,000, whatever amount you want to spend. I'm going to tie up the same amount of money either way. So would I rather have Toll or would I rather have Apple? The answer is I would rather have Apple. Therefore, I would not add Toll to my portfolio at this price. I'm not saying it's a bad trade. I'm just saying that if I'm going to put money into something that's going to double, I could do it just as easily on Apple, and I feel a lot more confident riding Apple out through a bad spike in the economy than I would Toll. Being a builder, we saw what kind of damage can be done to builders back in 2009. Not that Apple didn't get damaged, but long-term recovery-wise, Apple doesn't need to build. Apple's not going to need a bailout. It's not Apple won't need the bailout. The builders might need bailouts. They only need government intervention to save them. And I don't mean direct government intervention, but lowering the interest rate, so on and so forth. I don't care how bad the economy is, people are still going to buy phones. So for that reason, I would not add a bull call spread because it's not clearly the best thing I can do with the money. So I'm not going to add it. If the whole point of having these puts is we watch them and we watch them month after month and quarter after quarter, our attention is always drawn back to these stocks. And if it just goes up and up and up, then we make $5,000. We sold 10 puts, we make $5,000, and we're done with the trade. That's the end of Toll. I don't need to deploy another $5,000 just to make $5,000 more. Not on that particular stock. Plus, it diminishes my firepower for if something does go wrong. Now I've spent $5,000 or tied up $5,000 that I otherwise would rather have free to make adjustments to the positions we already have. And it might not be Toll, it could be something else that goes down and gives us a better bargain. So like FTR last week or a couple of weeks ago, FTR went way down, so we put money into that. I want to put money into the places that make the most sense. And in this case, then Toll doesn't really qualify because it didn't do anything, it just stayed flat. It's right where it was when we jumped in. Their numbers look solid. I think they're good. I'm saying I don't think there's anything wrong with a bull call spread on them, but for our portfolio's purposes, it's not necessary. CHK had great earnings, that's true too. And how they respond to theirs. We have all these stocks that we waiting for earnings for, and then we don't really bother when they come out and look. Oh, so CHK up 13%, very nice. So but we're already heavily into CHK also. In fact, I think we were very aggressive on them, if I remember correctly. Yeah, we had in CHK we have $52 calls, and I don't know if we did an adjustment on that or not. Phil Stock World. Oh, just so you guys know, when you ask me for something, here's what I have to do. I go to here, I go to comments, and I put in CHK, and then I can find all my comments on CHK. Probably a lot. This is my administrator thing that searches all the comments for things like that. $2,000 times we mentioned CHK. Then I do Control F CHK. And there. See, we should. This is without being adjusted. So we had this position, 50-50-50, basically, and I said, let's roll our 2020 $2 calls to the 2021 $2 calls and bought back the short $5 calls. Oh, very nice. Okay, so that's what we did. So we rolled these to the 2021s and we brought back, we uncovered them because I was expecting some good earnings. So there we go. That's what happened. And what is this one? This must be a smaller portfolio. This must be the OOP. Yeah, so that was the LTP, and here's the OOP. And in the OOP, I said, I believe nat gas exports will send prices higher one day. Again, I don't know when, but eventually. Let's roll out 25 January 3rd calls to 20 more of the 2021 $1 calls. Well, that was aggressive. And now we have 50 of the 2021 they're partly in the cover. Partly covered by the 350 calls and the short $4 puts. And that's our target. Oh, that was fantastic. Wow. Brilliant. Wow. That was an adjustment from that position. Oh, wow, that's complicated. Look how complicated it was, too. We had the $3 calls. We rolled them to more of the $1 calls. And we kept the puts. And what are these? The $1 calls here. Oh, I see. We rolled these $3 calls to more $1 calls. And we brought back the short calls, which is fantastic because now we're in great shape. So yeah, CHK did exactly what we thought it would do, and it looks like it's going to be in good shape. So I'm not going to worry about that either. And the S&P and the Nasdaq are green, even though the Dow is still down 60. That's interesting. Okay. All right. Anyway, guys, I have a meeting, so I'm going to keep this short. If anybody has any questions, ask now or forever hold your peace. Not much. Like I said, we're just sticking with the plan. We're seeing where where everything shakes out this week. But until we see the S&P over the 2800 mark and actually holding it, look, we're consolidating maybe for a move up. Where's the big chart? This chart's not big enough. We're over the 200, over the 200, over the 200, over the 200, at the 200 and breaking up. The Russell still has to clear its 200, but overall it's pretty damn good. No, see, got to go longer than that. That's where we are. So going back for a year or more than a year, we have made a big recovery. And now we're consolidating. Now, if we're going to break back over here for real, we should be consolidating at this line, which obviously spiked too high a couple of times. And here, and that line is more like here on the S&P, and more like this line on the Nasdaq, and more like this line on the Russell. So in the long term, in the weekly charts, we are right where we should be, consolidating. We never really consolidated for a proper move up. Here we consolidated and failed, which by the way can happen still. Here we consolidated and failed. That was only last year. Same time of year, same consolidation, then failure into February, March, whatever. Last year here, same thing, consolidate, fail. And consolidate, we went up, we actually blasted over here, but failed ultimately. And the same thing here, we blasted higher and failed. So, we can't get too excited about this, but it is healthier at least to consolidate along this line before trying to make a move up. This was very little consolidation before we failed, only 3 weeks. We're only into the 3rd week now of pushing at this line. A couple of more weeks, if this goes on for 3 more weeks at this line, I'll be more bullish, even though we're not going anywhere. Because it means that we've got a solid amount of buyers and sellers who seem to be agreeing at this spot. And then it would only take finalizing the China trade deal, fixing Brexit, the earnings were pretty good. So on the whole, I mean, that's out of the way. It really is about the China and the Brexit at the moment. And then, of course, Trump, I don't know what's better. I mean, no, obviously it's better if he's not indicted. It's not personally better. I think I'd like to see him indicted. I'd like to see him get taken out. But it's not really better for the running of the country and so on and so forth. So I think on the whole, market-wise, if Trump is not indicted, hopefully he won't be reelected, but at least he'll serve out his 2 years without too much craziness. So that would be a positive for the market. So you say Trump muddles through and the Mueller thing comes out, and then we still have the same president and there's no turmoil. That'll be good. If we make the China deal, that's good. And if Brexit can finally get dealt with, that's good too. And if India and Pakistan stop shooting at each other, that'll be nice. There's a lot of things that could be resolved that could help us go higher in the next few weeks in the month of March. So we're just going to watch and see what it is. Technically right now, though, this is a bullish consolidation, probably aiming for a move up. But if something negative happens, we can take a tumble just like we did last January. It wasn't January. I think it was into February, though. It was last year. When did it happen? It happened at the end of January. So we're way past that time now. We're into the end of February, and it hasn't happened yet. That doesn't mean it won't, though. It just you know, these things don't have to line up month to month. But we're in the same zone that we were last year. We took a, what is that, 8 to 6, 200-point drop here, not quite 10%. This was a big drop in January, but even from the reconsolidation here, which seemed like, again, seemed kind of bullish, we had the big drop again, and then we finally started heading up in the summertime. So we're not out of the woods. The month of March is going to probably look not too dissimilar from this. If we stay up in the top half of this zone, above 2750, and we keep bouncing around up here, it's a very, very bullish sign that we're going to head higher. But we don't know yet, and that means, and since we don't know, we're not going to jump into things. I'm not going to jump on deploying my cash just because I can make a double on toll, right? We can make a double on almost any stock. The question is, which ones do I feel so good about? And also, I would rather have my cash, because if I do, don't forget, if I do put my $5,000 or $10,000 down on toll, I then have to hedge against losing that money by buying more puts, and I'm going to throw that money out the window. So more longs means more insurance, means more losses on the way up. So we just want to find the best balance that we have. Right now, we just went through a whole process last portfolio review to get more cash and to have less positions. So I don't want to jump right into having more now. I don't mind selling a put on an interesting stock, but I don't want to keep committing to big positions. And that's it. Nobody had any more questions, so we are wrapping it up. All right, thanks everybody for coming. Next week, normal. Next week we're going to do a web. It's already March 6th. I'm leaving for California on the 8th, and that week I'll be gone the entire 8th to the 16th. Well,